Most traders lose money during the session, but the decision that caused the loss was made before the session ever started. Or more accurately, it was never made at all. No map, no buys, no scenarios, no risk decision, just a trader, a chart, and hope. And hope is the most expensive trading strategy ever invented. What I'm going to show you today is the complete pre-market ritual that separates professional traders from retail traders, not in theory but mechanically, layer by layer, signal by signal. By the end of this video, you will never open a chart the same way again. Stay with me. This one is deep because this topic deserves it. This channel does not teach patterns. It teaches how professional thinks before a single patterns appear on the chart. The preparation that happens before the session opens. The reading of positioning, liquidity, emotional state, and market structure is not separate from trading. It is trading, and almost nobody teaches it correctly. What I'm going to show you in this video was not learned from a course or a mentor. It was built from thousands of hours of direct market study, specifically from the question most traders never ask after a loss. Not what did I draw incorrectly, but what was the market already doing? Then I completely failed to read before I entered. That question produced this framework, and applying it session by session is what the operator build actually looks like in practice. Here is how almost every retail trader start their session. They wake up, they open the chart, they look for something to happen. No context, no liquidity map, no buys, no scenarios, no risk framework, no psychological check, just raw emotional exposure to a market that has already been moving, already positioning, already engineering traps, while the retail trader was still asleep. And then they wonder why they always feels one step behind, why they always seems to enter at the worst movement, why every move they catch turns against them, why the market always seems to know exactly where their stop is. It does. Not because the market is targeting you personally, because you entered unprepared into an environment that was specifically designed to extract money from unprepared participants. That is the market's function. It does not reward guessing, it punishes it consistently, mechanically, and without emotion. I want to show you exactly what this separation looks like in practice. Two traders, same chart, same session, completely different outcomes. The difference between them was not a strategy, not a skill, not experience. It was what one did before this session ever opened. Trader A opens the chart at market open. Price is moving aggressively upward, a strong momentum, clean breakout above, resistance. Volume coming in, he feels it immediately. That specific feeling of missing something, FOMO activates. He buys into the expansion. What he never checked, funding was deeply positive before open. The crowd was already aggressively long. Open interest had been rising for 6 hours. Leverage was staked. The London session had already swept liquidity below. The manipulation phase was complete. New York was opening. Historically, the delivery phase, not the continuation, of London moves. The higher time frame showed major resistance directly above. He checked none of it because he opened the chart looking for excitement, and the market gave him exactly what he was looking for. Price spiked slightly higher, swept the buy, stops above resistance, then collapsed violently. Funding flipped negative instantly, leveraged, longs got liquidated in sequence. The move downward was 3 times more powerful than the move upward. He panic excited, then revenge traded, then spiraled. Same story, different session, repeated endlessly. Trader B, before the session opened, already knew funding deeply positive, crowd learning aggressively long, danger. Open interest rising into resistance, leverage compression building, danger, liquidation heat map showing dense long liquidations below the range. Price has a magnet downward. London session created a fake expansion upward. Classic manipulation phase. New York opens historically delivers the real move, which would be the opposite of the trap. So when price aggressively broke upward at open, he felt nothing. Not excitement, not FOMO, not urgency. He recognized it immediately. This is the sweep. This is the trap I mapped this morning. He waited. Price swept the high. Funding spiked. Retail flooded in. Then the rejection came. He entered short with defined risk. calm psychology, and full contextual understanding. The trade ran cleanly because the market had already told him it would before it opened. Same chart, same candle, same session, completely different experience. The difference was not strategy, the difference was preparation. Preparation is not a side activity, preparation is the trade. The wrong belief sounds like this: I just need a good setup, find the pattern, enter the trade, manage the position. That is the complete picture. Also, retail education teaches what here is what nobody tells the developing trader. A setup without context is just a picture. The same bullish engulfing candle can be a high probability institutional entry or a perfectly engineered liquidity trap. The candle looks identical. The context decides which one it is, and context is not built during this session. Context is built before it. Retail traders look for trades. Professionals look for positioning, liquidity, and emotional imbalance. That single difference is what they are looking for, is why one group consistently loses to the other. Let me show you exactly how professionals build this preparation. 4 layers, every session without exception, and before I walk you through each one, understand why this matters structurally. A commercial pilot does not sit down in the cockpit and start the engine. Before every single flight, regardless of experience, regardless of how many times they have flown that route, they run a complete checklist. Not because they expect something to go wrong, because preparation is what makes them a professional. The market is your cockpit. This ritual is your checklist. Skipping it does not make you confident, it makes you reckless. Before touching a single chart, professionals read funding. Funding is the market's emotional fingerprint. It tells you which side is aggressive, which side is desperate, and where emotional pressure is building. In simple terms, positive fundings means longs are paying shorts, the crowd is aggressively long. Negative fundings means shorts are paying longs, the crowd is aggressively short. But professionals do not just read the number, they read the regime. Deep positive funding, the crowd expects continuation upward. Everyone is already positioned long. This is danger, not opportunity. When someone is already long, who is left to buy? Market makers will engineer a flush to liquidate the crowd and replenish liquidity. Typical behavior: slow grind upward, then violent collapse. Deep negative funding. The crowd expects collapse. Everyone is short. Short squeeze risks become extreme. Sudden violent pumps appear because they are not random. They are institutional liquidation of the short crowd. Neutral funding, balanced positioning, both sides uncertain. Result: chop. Fake moves, mean reversion. Both sides get strapped repeatedly. Chopping flip funding, funding rapidly changing direction. Algorithms hunting both sides simultaneously. Stay small or stay out. The most powerful funding signal: divergence, price rising with funding falling. Price move upward, but traders are shorting the move. Wealth absorbing quietly. Hidden strength, price falling with funding rising. Price drops but traders keep buying. Wealth distributing into retail optimism. Hidden weakness. These divergences are where institutional behavior becomes visible before the move happens. Professionals also watch how fast funding changes. Fast emotional shifts signal manufactured traps, not genuine moves. When funding spikes suddenly, market makers are forcing emotional positioning. Retail gets euphoric, then the dump begins. The speed of the shift tells you whether the move is real or engineered. Open interest shows how much leveraged participation exists in the market. It reveals whether new positions are entering or existing positions are closing. This tells you whether movement is sustainable or manufactured. 4 conditions professionals read every morning: rising open interest with rising price, new buyers entering the trend, healthy participation, usually sustainable, rising open interest with falling price, new shorts entering aggressively, bearish pressure, increasing potential continuation downward, falling open interest with rising price, short squeeze, move caused by trap short closing, not genuine buying, can be violent but temporary. Falling open interest with falling price, long liquidation event, weak longs being destroyed, can create exhaustion and reveals conditions afterward. Open interest compression zones, the coil before expansion, price trapped in a range, open interest rising steadily, funding is stable or slightly negative, meaning positions are building. Under compression, pressure is cooling. Eventually, one side gets violently liquidated. This creates explosive expansion. Professionals identify this before this session. Retail traders discover it after they are already trapped on the wrong side. Open interest blow off zones. The danger area: if open interest recently exploded and then collapsed, violently and emotionally instability are elevated. Professionals wait for stabilization and cleaner structure before entering. Most traders who discover the liquidation heat map use it the obvious way. They see a cluster, they aim for it, they wait, they works sometimes, but there is one specific reading of the heat map that almost nobody talks about. A configuration that does not just show you where price is going, it tells you how fast and how violently it will get there. I will show you exactly what to look for in a movement. First, understand the foundation. Price is attracted to leverage, not metaphorically, mechanically, because liquidations create volatility, volume, and acceleration, which institutions need to enter and exit large positions efficiently. So price moves towards stop. Leverage clusters, trap traders, liquidation zones. Professionals map these zones every morning before the session opens. They identify the nearest long liquidation cluster, the nearest short liquidation cluster, the largest liquidity magnet on the map, and the surprise liquidation zone. The level most traders have not noticed. These become target zones, not entry zones. They tell you where price is unlikely being pulled before it gets there. Most retail traders watch price. Professionals watch where price is magnetically drawn. That is a completely different way of reading a chart. And this is the heat map reading I mentioned. The configuration that tells you not just where price is going, but how violently it will get there. When you see a dense liquidation cluster sitting close to current price with open interest compressing and funding leaning hard toward one side, that cluster is not a target. That is an acceleration zone. Price will not just reach it. It will spike through it, triggering cascading liquidations before the real move begins. That is what separates a target zone from a high conviction entry. The trigger map is where professionals detect hidden instability and confirm or invalidate their scenario for the session. 5 elements. Read in this order: Bitcoin, Ethereum, correlation. BTC is strong, but Ethereum weak signals an unstable relay. Possible trap: Ethereum's leading BTC signals healthier risk appetite. Continuation more likely. Divergence between correlated assets is one of the earliest warning signals available. Perpetual versus spot divergence. Spot buying with perpetual selling signals bullish absorption. Wells buying real exposure while retail chases derivative. Spot selling with perpetual buying signals fake strength. Price move up on derivatives while real selling happens underneath. Delta walls, large delta cluster near key level signals market maker positioning. These levels act as magnet or barriers depending on whether they get absorbed or respected. Liquidation speed: fast liquidations signal high momentum and expansion conditions. Slow liquidation signal a choppy environment where traps from on both sides. This tells you before entering whether the market has the fuel to follow through. Failed breakouts from previous session. These zones becomes future trap zones. Professionals mark them because price frequently revisit and the emotional traders still trapped there provide the liquidity for the next move. Before all 4 layers, professionals also ask 3 questions. What type of market am I entering today? Trending, compression, distributing, rotating, expanding, or trapped in chop. Each environment behaves differently and requires a different approach. Who controls the market today? Strong hands, weak hands, retail leverage, institutional absorption, aggressive algorithms. Price behaves differently depending on who is trapped. And the elite question: what would surprise me today? Professionals build expectation and invalidation simultaneously because deviations from expectations are often where the real move begins. Retail traders ask, what will the market do? Operators ask, what would the market have to do to prove me wrong? That single shift is questioning changes everything. There is a 5th layer that most professionals frameworks never mention: yourself. Your emotional state changes how you interpret charts, not slightly, profoundly. A trader who is tired, angry, desperate, revenge driven, or financially stressed literally sees the market differently. Random candles become signals, weak setups looks strong, risks becomes invisible. So before the session opens, professionals check themselves. Am I calm enough to do nothing today? If nothing qualifies, am I trying to recover something emotionally? Would I take this trade if I were already profitable this month? Am I forcing action or waiting for genuine alignment? Retail traders prepare charts. Professionals prepare themselves because the most dangerous variable in any trade is not the market. It is the state of the person reading it. The pre-market ritual is not really about prediction. It was never. It is about emotional regulation. When you complete this ritual, funding read, open interest mapped, liquidation zones identified, trigger map built, psychological state checked, something changes. You stop hopping. You stop needing the market to do something specific. You enter the session already knowing where you were interested, where you are wrong, what the trap look like, what genuine strength looks like, and exactly when you will do nothing. That knowledge creates something retail traders almost never experience. Calm, not the false calm of someone who has given up, the deep calm of someone who has already done the work. A meteor mindset. Let me open the chart and see what is happening. Operator mindset. I already know what the battlefield looks like. Now I wait for my movement. A meteor. I need something specific to trade today. Operator. I need nothing. I am prepared for everything. A meteor. Why did the market trap me again? Operator. I saw the trap at 6 in the morning. I mapped it. I waited. I used it. The routine is not separate from performance. The routine creates the performance, and over time, the pre-market ritual becomes something more than preparation. It becomes an identity. The ritual trains the mind to move from reactive to intentional, from impulsive to structured, from emotional to observational, from gambling to professional execution. That is not a strategy upgrade. That is a complete transformation of who you are as a trader. Take a breath. I want you to sit with that for a moment, because what I just described, that transformation, it does not happen from watching a video. It does not happen from understanding the concept. It happens from doing the ritual session after session, before the excitement starts, before the chart moves, before the market gives you a reason to react. In the silence before open, that is where the operator is built. Which brings me to what I want you to do next. 3 mistakes that prevents the pre-market ritual from installing permanently. Mistake 1. Skipping the ritual when feeling confident. Confidence before the session opens is not contextual clarity. It is emotional positioning. The sessions where a trader feels more certain, most aligned, most sure about the direction are exactly the sessions where the rituals matters most. Because certainty without preparation is not an edge. It is the most expensive state a trader can enter the market in. Skipping the ritual on confidential days is skipping it at the highest risk movement. Mistake 2. Running all 4 layers as a mechanical checklist instead of building them layer by layer. A checklist is completed and forgotten. A ritual is built and owned. The trader who forces all 4 layers on day 1 runs through them without depth and concludes the ritual does not work. The trader who adds 1 layer at a time, who sits with funding for 3 sessions until it starts speaking clearly, who learns open interest before adding the heat map, builds genuine reading ability. The ritual must be earned through repetition before it becomes instinct. Mistake 3. Trading against what the ritual reveals. This is the most destructive mistake and the most common. The preparation was completed, the bias was clear, the positioning was mapped, the trap was identified. Then the market opened, a setup appeared in the opposite direction, and the trader entered anyway. Completing the ritual but ignoring the conclusions is not preparation, it is a performance. The ritual has one non-negotiable requirement. What it reveals is what gets traded, not the setup that appeared 5 5 minutes after open, not the move that felt obvious in the movement, what the preparation said before the market opened. Operators do not prepare and then improvise. They prepare and then execute exactly what they prepared for. Here is your challenge before your next session. Not all 4 layers at once, one at a time. Tomorrow morning, before you open a single chart, check funding. Just funding. Read the regime, identify the emotional positioning, ask, is the crowd dangerously leaning one way? Do that for 3 sessions. Then add open interest, then the liquidation heat map, then the trigger map, then the psychological check. Build the ritual layer by layer. Build a ritual forced at all once becomes a checklist. A ritual built layer by layer becomes instinct. And instinct is what separates the trader who reacts from the operator who executes. Most traders open the chart, professionals opens prepared. Subscribe. Every video on this channel builds the same framework from a different angle. This is the full operator build, completely free. The session outcome is not determined when the first candle opens. It is determined in the hour before, in the reading, in the mapping, in the questioning, in the movement you decide. Price moves where you are interested, where you are wrong, and where you will do nothing. Most traders discover the trap after they are inside it. Operators map the trap before the session opens and wait for the market to confirm what they already knew. That is not prediction, that is preparation, and preparation done consistently is the only edge that compounds.